Hey, everybody, it's Robert Dinan, your Florida Realtor, and we're here on the podcast today of Florida Luxury Living, all things Florida, all things luxury, and we specialize in sharing information and bringing on super guests to share their expertise in the space. Today, we have Thomas McCue with America's Mortgage Lender. He's a mortgage lender, or should I say mortgage banker, in the mortgage space here in the Sarasota, Lakewood Ranch area, but also from the New Jersey area as well.
Yeah.
So welcome, Tommy. Happy to have you here, my friend.
Hey, Rob, thank you very much for having me. Anyway, it's been a long time since I tried to get on with you a couple of times, but, I'm glad I'm here. I'm originally from New Jersey, and I moved here about 10 years ago. And, I moved my family down here. It's been an interesting 10 years, and I'm very
Well, I've seen a lot in the marketplace in 10 years, too.
Yeah.
A lot of different things have changed.
Yeah, no, when I first came here, I couldn't believe how much prices were suppressed. Now, prices of homes have went, since COVID, I think it went up like 50 to 60%.
Yeah, in some areas more.
In some areas,
Yeah. If we're talking about the, the barrier islands from Clearwater Beach, down to Longboat Key and Boca Grande, some of those barrier islands of the area have just, even this year exploded too.
Yeah.
In price.
You would think, with rates being, getting as high as they are, you would think that probably prices would come down. I don't see that happening right now.
You don't see rates coming down, or you don't see prices of homes coming down?
I don't see the prices of homes coming down. I do definitely see that we're going to definitely have some kind of a rate adjustment in the next couple of months.
Look, at the big question everybody's asking, right? Everybody's asking because people are living in a false world. That doesn't mean it can't happen because stranger things have happened recently. But, are we going to see rates that happened in COVID time again?
I don't think so. I think we're probably going to see rates go down to as low as probably 5%. That's what I think. That's
what's going to trigger that? Why would it trigger 5%?
Well, right now, things are coming. People's payment are becoming a little bit unaffordable, and not only that. Right now, I see a lot of people are holding off right now. Is redoing their homes, as in
like remodeling, renovations, renovations on their property.
Yeah, renovations.
And you saw a lot more of that, like people taking pre-locks on their properties.
Yeah, sure. Pre-COVID times. We see it.
Pre-locks are a home equity line of credit, right?
Yeah.
Okay.
We're seeing a big uptick of that right now, but not as much. We would figure we would see a driving force because of rates are being so high right now. Rates are in the 6.875-7%.
Let's talk about rates being high.
Yeah.
Okay.
It's really not that high.
Correct.
Yeah.
Because if we're looking at the past, I'm going to date myself, 30 years.
That's true. In the 80s.
Well, 30 years.
That's
30
before,
years. Yeah.
We weren't buying houses.
We weren't buying houses
That's right.
then.
Yeah.
No, but 90s. If we're looking at 30 years of mortgage rates, the average rate was 8.5, right?
True.
So we're adjusting. We as human beings adjust way too quickly to certain things. We saw that prevalently during the 2020, 21, 2022 era, how everybody could adjust very quickly to what was happening, from not going to the office to working from home to a lot of different things that happened. Zooms, that wasn't before.
I didn't even know what Zoom was.
Yeah, I know.
Yeah, that's true.
People made changes and adapted very quickly.
They did.
And I think, their mindset adapts too when it comes to, the rates were this, now they're going to be this. So you have people sitting on the sidelines, which I think some people are making a big mistake doing that.
Yeah, yes and no. Like right now, disposable income has a lot to do with it too, right? So, groceries are costing a lot more money to everybody. So it's a disposable income kind of situation. And that's what I was trying to say before. I'm shocked that home prices did not come down yet. And I don't see them coming down because if they haven't come, we have an inventory problem, right? Mm-hmm. Here in Florida, too, we have an inventory problem, even though the builders can't meet up to the demand. Everywhere you go, you see they're turning over soil and you're saying, oh, my God, there's another development. But all of a sudden, that development becomes filled. We have definitely an inventory problem. So that's one.
So a lack thereof is what you're saying.
A lack of inventory. Yeah, definitely. I know we're like jumping all over the place, but
it doesn't matter. This is what we're here to talk about. So we're good.
Yeah,
that's good. We don't have to follow any kind of scripts here. This is informational for everybody. So these are conversational pieces. So it's fantastic.
Okay. But anyway, to get back to, where do we see the market going? If they do lower rates, which we see that Powell's probably going to lower the rates somewhere in September. It's election year. They usually do anyway. They start the election up.
Right.
So we see that happening. With the rate decrease, don't forget, too, that is not the same thing. When he does lower rates, that's the Fed borrow rate. That has nothing to do
with what rate I'm going to get as a borrower.
That's correct. We're off of mortgage-backed securities, right? We filed the...
So let's talk about it. If it's a 6% rate.
That's correct.
Okay, that the Fed puts out there.
That's right.
What does Rob Dinan get if he comes to Tommy?
Well,
and I know there's a lot of variables, but it's not 6.
That's correct. It's not 6.
Right.
But we go off the 10-year Treasury. That's where everything's pretty much tied into. Right now, if you look online and you see the 10-year Treasury bond, at one time it was off the 30. Now we moved it back in 2000. I can't remember exactly the date. But we actually now go off the 10-year Treasury, and it's actually clumped back and all with mortgage-backed securities. So as you start seeing the 10-year trickle down, then what it really has to do with mortgage-backed securities are tied into the 10-year Treasury. That's what it is.
The 10-year Treasury with mortgage-backed securities are working.
That's it.
Yeah. So now, being in this business, Tommy, for how many years now?
Too many.
Too many.
About 30 years I've been in the business.
About 30 years.
30 plus years.
The thing that's a degree of separation with you as the owner-operator of America's Mortgage Lender here in Florida and in New Jersey area, and I think you're in a couple other states as well.
Yeah, we are.
So, Tom, you're in New Jersey and in the Florida marketplace.
Absolutely.
And then a couple other states that you work in. So let's talk about what most people are looking for and the degree of separation with working with you compared to working with an institutional bank. So you're a mortgage banker. Can you talk about what a mortgage banker means compared to being a mortgage broker?
Sure. We're a mortgage banker. What that means is basically, we use our own funds to fund the loan. All right. And from there on, we underwrite the loan. We process the loan, and what we do is we have the availability, which we don't do at America's Mortgage Lender. We can service the loan. If I had my Fannie, Freddie, Ginnie, we don't do that. So a broker, on the other hand, he goes out there and he has to shop the loan. He has to go out there and he has to go on the discretion of somebody else.
Right.
So what that means is he has to worry about some other underwriter somewhere else, and they could be in Alabama or wherever have you. He has to worry about their decisions, how they're going to evaluate the
deal's out of his hands. It's out of his
pretty much. He has no control of the loan.
So when you're controlling the deal, when you're controlling the loan, you're controlling the deal with your elite team.
That's correct.
To focus and get that deal done.
So we have complete control of the deal from fruition of the loan.
And you're talking to everybody this whole time, and it's a smaller group. It's not going from, as an institutional lender, like the big banks, from Sarah's desk to Mary's desk, and they don't even know each other, and to Fred's desk and Angela's desk and all over the place. Your team has it from start to finish.
We do.
Yeah. And you handle everything within house.
That's right. Nothing set in different locations. We do everything in-house. We're all in communication with each other. And our biggest strive is to get your borrower a closing. That's it. That's what we strive for, to close the loan.
And obviously you do it very good rates too. Yeah. I mean, you're very competitive in the market.
I think we're super competitive. I think we're as competitive as any other big bank out there right now.
Yeah.
If not more. I mean, I call it, I say we knock the snot out of some of these big banks.
Absolutely. Absolutely, Jim. Yeah. I mean, and you don't have all the, if you say it's 30 days, you're getting it done.
We don't have no overlays. That's another thing that's fantastic. I mean, we don't have any overlays. Some of these banks, they put all these overlays on there saying, all right, you have to do this, you have to do that. No, we just pretty much, to the discretion of our underwriters, of myself and my team. And like I said,
signing off on the deal at the end of the day once it's through the process.
Like I tell everybody, it's my money, my processors, my underwriters. And that's what it really comes down to be.
Yeah. And that's how you've been successful over these years and stayed in the business through every aspect of the business.
We're an anomaly, Rob. That's what I have to say. We are definitely an anomaly. I tell everybody, my example is we're playing in Yankee Stadium, and we should be in a little bit of a minor leagues, but we're there. We held our own ground. We lasted every inning of this financial moment.
Right.
We have.
From start to finish.
For 30
years.
30 years. No, we definitely had a great time through COVID. COVID was fantastic. And, we continue to push on forward and hopefully have as many graceful years as I had prior to, that we'll have some more graceful years going forward.
Well, yeah, absolutely. And I will tell you, the people that I have referred to over the years have just praised you.
It's good to hear.
And you're a great resource for a lot of buyers in the space for sure.
Oh, thank you. That's great. That's great.
So let's talk about a couple of questions that you probably get all the time, and I get asked these questions. Not being in this space, I always refer out to a professional like yourself. So people talk about the different types of loans that are out there, right? You always joke about the A's of the loans, right?
That's true.
So you're talking about the A's of the loans. Why don't you talk about the types of loans that are available?
So how I break it down into A's, we have FHA, which everybody pretty much knows, a VA loan, which is you have to be a veteran,
right?
And then we have a USDA. So USDA is
rural
agricultural area. Right. Yeah, absolutely. So FHA loan is a 3.5% down. I mean, a lot of people why would they get that? Is people with a little bit less of credit scores,
less of a down payment,
less of a down payment. So all we're asking you to do is put 3.5% of your own money, or it could be borrowed funds. It could be not borrowed funds. It could be gifted funds.
Uh-huh.
That's
so when mom and dad helps me out to get that 3.5% down, that's okay with FHA.
Yeah,
that's the rhyme of the day. That's okay with FHA.
FHA is okay. That's exactly right. Yeah, no, FHA is we find it's probably one of the best driving utensils for lending. I mean, I love FHA because credit scores too. I mean, we have some people that come in with a little bit less of credit scores, and FHA lets you go down to 500, but that's going to be hard for any institution to do that low of a score. But we definitely, go down to 580 and up to six something, up to 780. I mean, up to 780, 800. Yeah. 800 credit scores. So FHA, that's FHA. VA, as we know, you have to be a veteran.
Right.
It's an unbelievable program out there.
It's fantastic.
They're really, really
absolutely.
And that goes by their voucher and whatever they can, whatever the VA says they can get.
VA says they qualify.
They qualify. Yeah. As VA qualify.
Yeah.
And then USDA. And USDA has a map and it has an income calculation of what you have to make and stay under. And
we don't see too much USDA in the Florida space unless we start heading further out east, right? I mean, you don't do a lot of USDA, but you've done everything. So, I mean, 30 years of experience here.
Very true. But I'm going to tell you, my 30 years been in the business, I probably did a handful of USDA. Right. It's tough
from New Jersey and
that's true too.
And being from the west coast of Florida, it's different.
Sure. But when I first came down here, let me tell you, I thought this was going to be USDA
Central.
Yeah, because when I first landed here, I call it Plymouth Rock. I came down here seeing a lot of cattle, a lot of horses, something I'm not used to where I came from.
Of course, yeah.
So,
I mean, there's been some significant changes that we've seen on the west coast of Florida, in the space. I mean, and I think that was driven by a lot of different reasons, but we won't get into those today.
Yeah.
But, another question that people typically come to me and ask, and I'm sure you get this question all the time, is how much do I qualify for? How much can I borrow? How much money can I get?
Yeah.
And that's a major question, and that's something that, what do you answer that question when people ask you?
Well, first we want to find out about their income, right? So we want to know if they're a W-2 earner or if they're self-employed. I mean, some people are like, oh my God, I'm making $500,000 a year. Well, okay, when we get their tax return, we come and look at it. I'm like, oh my God,
but you're self-employed.
Yeah, you're self-employed. You're not really making self-employed. You're writing off as much as possible, and they're like, all right, here we go. We got a headache over here. So we look at their income. We figure out what is their net income, what are they qualify for, and we figure that out. And then we look at also their down payment. What do they have?
Down payment's important, right?
Very, very important.
Yeah. That impacts their monthly payments.
That is one of the major things. I mean, we want to look at, all right, how much disposable income do you have and how much disposable income you have for the payment? That's another thing, too. Some people, they have these car payments. That's notorious. I mean, we get Mr. and Mrs. Jones come in here and we start looking at their credit report and they have their sons, their daughters' car payments. They went out there, who's got a Mercedes, they bought little Johnny a Porsche. And
they got $3,000 out there a month in car payments.
Yeah, I know. And then we have a hard time qualifying. So we take everything from their income to the down payment to everything that they're looking at.
To use as their quote-unquote collateral to be able to do it. Now, the question is, too, when you see these people and you see them coming in to buy or to borrow money in the space, a lot of these people that are self-employed or have lower credit scores, I mean, the typical institution, and I'm not going to mention the names of the banks, but they're going to bump you out right away.
Yeah.
No matter what. You have a more concierge approach to it.
We do.
And, when you talk about that, it comes to my third question, really, is what rate do they qualify for, right? And people always want to talk about the rate. We just spent 5 minutes talking about the rate, right? Or rates.
What's the one thing that we look at when we look at rate is your credit score. Yeah. That's it. I mean, everything ties into your credit score. And then your down payment is another thing, too, that we just spoke about. But you know what? Credit score is a very, very important thing. Unfortunately, I mean, everything...
Fortunately or unfortunately, it's a very important thing.
It is. Unfortunately, I mean, people don't realize that,
three institutions running the credit scores.
That's another one. Yeah, isn't that something like, I'm going to go shop?
Yeah.
They don't realize, I mean, shopping for a mortgage is not the same thing as shopping for a car, because if you go into several different places, we're doing a hard pull. The difference between a hard pull and soft pull is that...
But that's the hard pull of credit for the person.
Yeah, hard pull
just for the people that don't know what that is. Yeah. A hard pull and a soft pull of credit for what you're able to, quote unquote, borrow, correct?
Yeah. Yeah, so I have like Mr. Jones call me up, and I use that word, Mr. and Mrs. Jones, because it's a common.
Fred and Ethel.
Yeah, that's it, Fred and Ethel, yeah. So they'll call us up and say, I just pulled my Credit Karma and saying that I'm at a 700 FICO score.
Yeah.
We do a hard pull when it comes to a mortgage, and we're like, okay, listen, Mr. Jones, I'm sorry, but we have some bad news for you. You're at a 580. He's like, well, how can that be? I just paid off. I'm like, listen, unfortunately, I use that word unfortunately, the credit bureaus unfortunately do things a little bit different than
Credit
Karma does. Yes. So one of those things that they actually, it's a different credit pull.
Yeah. your credit score, really, this is, my fourth question really leads right into this, which is perfect. How big, right? How big is that credit score impact my mortgage application, right? I mean, and that's probably one of the most important things of the whole process.
It is.
If I come in with a 600 credit score and I'm looking to get a 7% rate, typically you're going to be on the borderline of being able to do something like that. So how do people improve their credit scores? What are ways that they can do that? I mean, obviously we talked about maybe you stop paying those car payments, maybe you pay off the car, one of the other things, but what are some quick fixes, that people can do?
Well, the quick fixes are, not maximizing your credit cards. When you look at credit card balances, you have the credit card balance.
Yes, you're 95% maxed out on your card.
That's right.
Yeah.
Yeah, and then
that
allowed
credit
how much credit they allot you, right? So let's say ABC Bank, it says gives you a 4,500 credit limit. Some people go up to the 4,500.
Oh, yeah, first week.
That 100% affects your credit score. So how you could improve your credit score is we do a credit analyzer. And from what we'll do is we'll take that credit. We'll look at if you pay down, X amount of credit cards, you paid off your car payment, and hopefully they'll give us like a score with the credit
analyzer tells you to do. And now when you do that, is that something that's a courtesy that you do for people, or do they pay you for that?
Well, it is definitely a courtesy. Yeah,
but in the hopes that they will do business with you in the future.
Yeah.
Right, of course.
Yeah, but when it comes down to when them paying that off and we do a credit supplement, then it's a little different story. But that's when these credit agencies right now, they're just charging the consumer way too much money. It's changed. And then that's another thing that changed in the last 10 years. It's been outrageous what they do to the consumer. And that's another thing that we can speak on.
Because of the introductory rates that they bring them in on, and then what they get to after 40, 60 days, what they start charging these people.
Well, just improve their credit. It was just another thing.
Oh, to improve their credit.
Yeah, that's another conversation.
That's a whole other conversation.
Oh my God. Yeah. That's another institutional cleave that we have going on in today's market.
Indeed.
That's it.
So we go through the process. We're doing the loan process with you. We've been flying colors from the beginning. We're going to get approved for the loan. Happy to buy the property, right? What are the fees that people have to be concerned about when they're purchasing the home? Because now they have their down payment down. What else do they need? I mean, are there going to be other fees involved?
You're talking about closing costs, Rob?
Well, yes.
Of course there's closing costs.
And appraisal fees, maybe?
Yeah, so appraiser, we call it third-party fees.
Third-party fees, of course.
So when it comes to buying a house, we have to have the house appraised. We have to find out what the true value is of the house. It's one thing what realtors are selling for, what everybody's reaching for. The seller is looking for the home.
Well, their home's the best home in the world.
Well, it is, right? It becomes very emotional. Yes. Isn't this a very emotional kind of situation that's going on? It really is. It really is.
On both sides.
Yeah, it definitely has on both sides. The seller and the buyer is definitely emotional. Yeah, so we have to find out what the true value is, right? Sometimes we have to do 2 appraisals. New construction, we have to do a finished. We have to do a finished appraisal. So we have to do a trip charge. So that's the first of the appraisal fee. Then we have title fees. That's to ensure the property that there's any liens or encumbrances on the property itself.
Right.
So that's another.
Uncle Fester isn't crawling out of the backwoods saying, I own 25% of that property you just bought, Tommy.
Mr. Mechanic lien. He went out there and got some kind of, the seller got some kind of work done and
didn't never pay.
So we have
There's an argument between them. Yeah, who knows? Yeah.
That fee, which is title fee, could be, that's a state mandated charge, which is great. And, we don't control that.
Yeah.
And then we have also recording fees. That's to record your deed, and we have those fees. And sometimes, like VA would ask for termite inspection, or
certain rules or regulations.
Certain rules and certain
right. Yeah, some things may not apply to others, and something that way.
It definitely could be a little costful, and like I said, here in some of these new construction areas, and I say all these new construction builders, they have their own associated fees too. And when I came here, I'm like, what? This is a fee? This is just to hook up their water. It's like
right.
So it's like I get shocked when I get nervous for the buyer when I see this. So I'm like, but
especially on the new construction. The sewer hookup, the water hookup.
They pass the cost over to the buyer.
Everything.
Yeah, they really do.
Everything. Well, that's because those are the new the CDD fees. That's
another conversation.
Yeah, yes.
It's with insurance. I mean, we definitely have a lot of room for a lot of conversations. Mm-hmm. Insurance in this area has went up drastically, and so that's another conversation we can have. And what's causing that to happen?
Right.
What's the solution for that?
Maybe that's a good question. I mean, the thing that we're seeing the most in the real estate space, and I know you see this too, of course, but you can't get that house insured. The roof's too old.
That's true. Yeah.
So that comes back to us.
Roof inspection. Yeah. Now we have to do a roof cert.
Right, a roof certification, or they're going to have to fix the roof or do the roof over, or put an allowance out for the roof to get done. Now, have you seen, I know we're going a little bit off topic here, but have you seen sellers been able to say, hey, listen, we'll fix the roof, but you guys close, and then would that be an acceptable practice?
You do it prior to or after, you say?
After.
Depends upon, what effect of the roof is not insurable.
Right.
Right. So
it's not happening.
Right. So that's
and you need. So when I'm buying a house, I have to get insurance.
Mr. Rob, unfortunately, you do. Yes, you do. Yeah, insurance is required, and with that insurance.
So what does insurance cover?
It's based on with the house. It's to make sure that we, as the lender, are going to be
are protected,
indemnified.
Something that does happen, flooding, fire.
Yeah, it's not for flooding.
Okay,
that's an totally additional
cost.
Yeah, the home would be insured if
something were to happen to the home.
The mortgage will be insured if something happens to the mortgage.
Right.
I mean,
they're covered. They're covered.
Yeah, that's right.
Right. The company's covered. That's why the insurance is in place.
That's right.
Yeah. Right. Because got to protect the money.
We got to definitely protect the banks.
Yeah, protect the bank.
The banks are definitely protected.
Yeah, for sure.
Yeah.
For sure. So if they're looking to do a loan, if anybody's looking to do a loan, what do you tell them to get prepared before going into the process? Do you think people should start looking at houses first, or you think they should go and get a pre-approval and get that process started first?
We definitely like to have them get pre-approved. I mean, what that consists of is pretty much analyzing their credit, looking at their income, looking at their down payment, and making sure that it's affordable. We just want to look at their credit, but making sure, and like we spoke about before, they don't have any exuberant credit card bills, any car payments, and everything else of that nature. Student loans, another thing that could put things go south with student loans. So that's where we look at. So we love to have all that data. We'd love to have all that data prior to them, so they know what they can afford. That's correct. Yeah, no, definitely.
They know what they want. I mean, if your expectations are here, and you qualify here, you got to fill this with something.
That's correct.
And that may be savings. It may be another loan from somebody or a family gift, I should say.
Sure.
But,
so
that's the loan qualification process, and getting pre-approved is definitely, I think, your first step in the whole process. That's what you would say. That's something you guys should go out and do.
Absolutely. Yeah, I'd always say have the piece of paper, know what you can afford, know what you're getting yourself into.
Right.
Instead of not being, not knowing it all.
And you're educating yourself too in the process. Yeah. And if something is sideways, you can provide them with that credit adjustment calculator or app that you have that will tell them this needs to be fixed. Take this off, pay this off, do this, do that, and help yourself. And let's revisit.
Yeah.
In January. Let's revisit it in June.
That's it.
Some people months later, it changes extraordinarily with a couple payments here or there.
Yeah, very true. I mean, that's where sometimes people's expectation is a little bit higher than what they really could afford. I had a college kid just graduate, and he just took a job, and he's like all excited. And I was happy for him, right? I was like, all right, that's good for you, this and that. And I'm like, okay, well, how much are you making? What are you making? He's like, oh, I'm making $60,000. I'm like, okay, listen, let's wait a couple years. Let's wait till you get a raise or where you're going to go for, down the road.
Because what you're looking at is not going to fit that rate.
Yeah, not at that
number.
Yeah, at today's number, it's going to be tough, right? $60,000.
Crazy.
I know. It's like, it really is.
It's crazy.
Things have changed so much. That's why, we're saying, that's why I have to say that things have to get a little bit more affordable for the blue collar, the police, the teacher,
the cop, the fireman, the teacher, the casual dining worker, the nurse,
the tip worker, the restaurant worker, the hospitality worker,
the big box store people. I mean, all that stuff.
Yeah, it has to be a little bit more affordable because it just became, it became unaffordable. It's like 6 times their income that they have to make to around here for affordability, but that's all over.
It's just a microcosm of Florida.
No, it's actually, as we touched before, I think it's an inventory problem. So people that are at 2% or 3% rate, they don't want to move right now.
Well, they're not. Yeah, they're staying where they are. Right?
Yeah. Why would you move?
Well, because the obvious reasons, right? We know what they are.
Yeah.
Job transfer, death, dying, divorce, too much debt. They have to go.
Absolutely correct.
Those are those things, right? But for the most part, if people are fine with their rate, they're not gonna. Where can they trade up to? That's the question. And if they do trade up, what's that rate going to cost them?
That's true. And that's been the problem. That's been the problem in the last year and a half, 2 years. I think ever since COVID happened, people did their trade up. They were able to catch that right. They caught that right. I mean, because like I said, I keep on using it as when COVID happened because and you probably know better than I.
It was extraordinary. It was extraordinary. It was beyond a marketplace that, listen, a lot of people did very well for themselves, and good luck to them, and fantastic job.
Yeah.
But I will tell you, for the real estate side of the game, it was brutal.
Yeah.
It was brutal. Not only brutal for the agents, but brutal for the customers. You had so many people, again, we talk about emotion, right?
Yeah.
Emotions. I mean, people were bidding on houses with freaking active roof leaks for $2 million and waiving inspections and doing this and doing that and paying cash. And it was crazy.
I was getting phone calls from people from all different states, all right? And they were just like, all right, I don't care. Just get me qualified. I'm buying this unseen. I mean, I personally, not people on the team, not people in the brokerage, but I personally did 89 different offers during a 1-year period, 89 customers, I should say, probably 2 offers each. So, I mean, do the math. So more than 89 offers, I correct myself. But, I had people doing even, a couple of people that we know, Mr. Scott Sullivan there, we offered on 6, 7 different houses. Yeah.
Until he finally got one.
He got what he wanted and then he didn't back out. He sold it a year later, 2 years later, and capitalized and made money on it. That's it.
I did outstanding for himself. He told me I was
God bless that guy.
That's yeah.
And we got numerous phone calls from people that bought things unseen, and then they fly down here, and then when they fly down, they're like, okay, I'm walking this unit. I want out of this thing. How do I get out of it? I'm like, well, you're closing tomorrow. That's it. I mean, you cannot get out of it. We're at the closing table. This is not what the realtor promised me. I'm like, listen, I think that's your problem. It's not the realtor. The realtor presented it to what it is, and that's where you are right now, and you have to close on it. So it was definitely a unique time. It was crazy. It was
insane, and it was, doing things, people were doing things. I was like, I'm going to be honest with you, Mr. Jones, I'm not comfortable with that. I'll do what you want.
Yeah.
But, sight unseen, millions of dollars, waiving inspections. These are certain rights that you should execute when buying a home. And
I agree.
People were just waiving that and, rolling the dice and taking chances. And a lot of them did okay.
Yeah.
A lot of them did okay.
Sure.
A lot of them did fantastic.
Yeah.
But, there's some, like you just talked about, this is not what I expected. No. This is not what I wanted. But, so be it.
Yeah, no, the buyer rights went right out the window. We were talking about the different times now and people being with a lower rate and what's driving. Why aren't houses coming down? And with affordability, we're talking about the affordability. That's what we're talking about.
Right, the affordability.
The affordability, yeah.
What that looks like.
Yeah, we're definitely, I'm hoping somehow, some way, we come up with a way. Maybe it'll be...
It's going to have to be lower rates.
Yeah.
That's what it has to be. Because, you have to, like I talked about earlier, there are people sitting on the sidelines waiting for those rates to come down.
Yeah.
Now, what happens when those rates come down? Let's talk on that, because rates come down. Now there's the market's flooded with buyers.
Yeah.
The inventory is a little bit less than expected at these times. More of a normalized market than it was before. And now what happens?
Yeah.
Supply and demand model kicks in.
It does.
My house is 500. I'm getting 6 offers at 500. Why did we make it 550?
I was reading something the other day, and I don't have the exact numbers, but I was saying, looking at payments, like people's payments in 2020 was the average payment was like $1,200 or $1,300. And then 2021, it went up to like $1,400. In 2022, it went up to like $1,600. As we started going 2023 and 2024, we're at $2,600. People's average payment. So I always say, I think that's underestimating people's average payment, because I'm seeing 46.
That's a national thing.
That's a national thing.
Yeah.
So I'm seeing 46 or 6,000 is what I'm looking at in the area markets that I'm in.
Right.
I'm at 6,000, 4,000 to 6,000. And I always say, we're going to use that Mr. and Mrs. Jones again. Mr. and Jones, when they lose their job, they can usually, no problem, pay a $2,400 payment.
Correct.
But to pay a $6,000 payment, that becomes a little tough. So that's where I think that there's going to have to be some kind of adjustment.
The mortgage payment.
That's just the mortgage.
That's not the 2 cars. That's not the kids' school. That's not the going out to
the
eat.
daily life.
That's
right.
Right.
That's right.
Because that's increased too. So.
Yeah. No, we definitely know. Every time we go to a restaurant, we look at that check and say, "Wait, hold on, was that the same? That was the same price?" No.
Yeah.
So our
dinner is what do I say? I say now that dinner is the price of lunch is the price of dinner now.
Yeah, that's right.
In restaurants.
Yeah.
Lunch is the price of dinner.
Lunch is definitely the price of dinner. And you go to get a cocktail and you're looking at your price. I'm like, all right, it was $12. Now it's $18. Mm-hmm. So things are happening. Things are changing, and our pockets are getting hurt. And that's why, on the mortgage side of it, we're hoping that, the rates come down I don't see rates going down to where it was prior to, but I definitely see, a happy medium. I think that 5.5 is a happy medium.
So we're here right here, folks. Tommy McCue, 5.5.
5.5 is definitely a happy medium.
5.5 is definitely a happy medium.
For people's pocket.
Good.
And we would like to see 5%, but I'm using that half marker.
Right.
But the 5% is would be great. But 5.5 is, I think that's what we're going to go.
That would be outstanding if something like that.
It definitely would.
So Tommy, again, I thank you for being on the show. I appreciate it. A wealth of knowledge here for all of you. If you want to meet with Tommy or learn more about the mortgage process, reach out to Tommy McCue directly. I'll include his number below. And don't forget to like, follow, subscribe, and share, and hit the bell for any notifications that we have in regards to the podcast. This is Robert Dinan, your Florida Realtor. Have a fantastic day, and we'll see you soon.